This trend is particularly telling because layoffs often precede higher unemployment rates. Here are 10 big companies that have been slashing
Time
jobs.
to take your wealth to the next level. Welcome to Learn Wealthy, your go-to channel for real estate insights, market charts, and golden opportunity. Let's build wealth together.
How's it going, everyone? My name is James Santiago, your host. Welcome back to your channel, Learn Wealthy, where we do a deep dive into the world of finance, economics, real estate, and market trends. Today's episode is going to be juicy. If you haven't already, hit the subscribe button so you never miss a thing. Today, we're going to talk about why I believe the next Bureau of Labor and Statistics, BLS unemployment report, will support my base case of a looming recession. Let's break it down. The U.S. economy has been showing signs of slowing down over the past several months. From rising interest rates to tightening credit conditions, the macroeconomic environment is creating a perfect storm. But one of the key indicators that I believe will confirm our entry into recession is the upcoming BLS unemployment report. Unemployment data is a lagging indicator, meaning it tends to show signs of a distress after the other economic indicators have already turned south. However, recent trends in the labor market, particularly layoffs, suggest we might be closer to a tipping point. Let's talk about layoffs. Over the last 6 months, several major U.S. companies have announced significant workforce reductions. This trend is particularly telling because layoffs often precede higher unemployment rates. Here are 10 big companies that have been slashing jobs. Amazon, the tech giant, has laid off over 27,000 employees as it scales back on pandemic-era expansions. Meta Facebook has cut more than 21,000 jobs as part of Mark Zuckerberg's year of efficiency. Google Alphabet announced layoffs impacting 12,000 employees, citing a need to focus on core businesses. Microsoft, in response to slowing growth, Microsoft has reduced its workforce by around 10,000 employees. Disney has undergone multiple rounds of layoffs, cutting about 7,000 jobs amid restructuring efforts. Goldman Sachs, the investment bank, has laid off roughly 3,200 employees as part of cost-cutting measures. Salesforce reduced its workforce by around 8,000 employees due to declining demand in a post-pandemic world. Walmart has announced layoffs in its corporate and tech divisions, with job cuts affecting about 2,000 employees. PepsiCo has cut hundreds of jobs in its North American beverage division as part of restructuring efforts. Lyft, the ride-sharing company, has slashed 1,200 jobs, representing about 30% of its workforce, in an effort to cut costs. These layoffs aren't isolated incidents, as we've talked about other similar companies in this channel, such as McDonald's, Starbucks, Home Depot, Airbnb, Delta Airlines, the dollar stores, and many more. They're reflective of a broader economic stress. When companies of this size start cutting jobs, it's a sign that they're bracing for tougher times ahead. Interpreting the unemployment report. So, how does this connect to the upcoming unemployment report? First, let's look at the initial claims for unemployment insurance, which have been steadily rising. This indicates that more people are being laid off and are seeking benefits. Additionally, the labor force participation rate is another critical factor. If people start dropping out of the workforce, it could signal that they are losing hope of finding a job, which often happens before or during a recession. The next report could show an uptick in the unemployment rate, a decrease in job openings, or a significant drop in the number of hours worked. Any of these would be a strong signal that the labor market is cooling off, precisely what we'd expect to see that will lead up to a recession. Implications for the economy. If the unemployment rate starts to climb, it will likely have ripple effects throughout the economy. Consumer spending, which drives a significant portion of the U.S. economic activity, could take a hit as people lose their incomes. This would lead to a slowdown in demand for goods and services, further exacerbating the economic downturn. Moreover, the Federal Reserves might be forced to rethink its monetary policy. A rising unemployment that could compel the Fed to pause or even cut rates. But that might not be enough to save the economy from a recession if we're already too far along the path. Conclusion and call to action. In summary, the upcoming BLS unemployment report could be a crucial piece of the puzzle that confirms we're headed for a recession. The significant layoffs we've seen across multiple industries are a red flag that shouldn't be ignored. Keep an eye on this report, and if you're concerned about how a recession might impact you, now is the time to start planning and preparing. Make sure you get notified by the bell and subscribe at Learn Wealthy if you want to stay informed with the BLS unemployment report news and other important economic events. If you want to know why the gross earnings on a company's earnings report are great recession indicators and why the net earnings are not that much, watch the next video and learn wealthy. Let's all learn wealthy together.